Hello, everyone. Happy Thursday, and welcome to our webinar today on the Business Owner's Financial Game Plan for 2021. My name is Trilby Lawless, and I'm our content manager here at Big Time Software. And also joining me today is Matt Rinke. He's our speaker today. Maybe some of you remember him from our past two webinars on the PPP loans. He is the president and founder of Illumination Wealth and has a lot of great knowledge to share with you all today. But before I pass it off to him and just to give everyone a few more minutes to join us, I want to go through a few things. First of all, this webinar is being recorded today. So after the webinar is complete, I'll make sure to get it up live on our blog and send an email to all of you with the recording by tomorrow morning in case you want to share with any of your colleagues or go back to reference. We will also be making a copy of the slide deck available too, which you'll be able to find within the webinar recording in case you want to save that for notes. And then second thing, we will be doing a live Q&A at the end of today's webinar. So if you have any questions throughout the webinar of things that Matt's covering or things you're curious to know, chances are someone else probably is too. So please feel free to submit those into the questions box you see on your screen. And then I'll be back on the end to hand those over to Matt. We'll get through as many as we can live today, but of course, if we don't have time to cover your question, we will follow up with you via email to make sure we get everything answered. So thank you all for being here. I really appreciate it. And with that, Matt, I'll go ahead and hand it over to you.
Sounds great. Thank you so much. Well, it's a pleasure and an honor to be back with you and your clients. Hope all is well. And let me get back here to talk about what the agenda is today. So few things that we're going to unpack today. One, we want to talk about the recent stimulus loan and tax credit enhancements that have changed that are impacting business owners all over the country. We are also going to dive into a high level of the proposed additional stimulus through the new president, as well as some of the tax planning changes that could be on the horizon with a new potential tax plan. And then we're going to also just get into a few tax reduction strategies that are timely for business owners and entrepreneurs today with this ever-changing tax code. So feel free to jot down some questions. At the end, we'll do our best to tackle them. And also, we wanted to do our best to keep this kind of high level. There's a lot of technicalities underneath the surface of these topics that we will do our best to explain and explore. And if we need to take a question even offline to dive into the nitty-gritty, happy to do that after today's conversation. So the legal stuff, this is really for information purposes only. You really need to make sure that you're getting the appropriate specific advice to your situation. And there's still ever changing and evolving guidance and guidelines, even for some of these ongoing stimulus programs and loans. Like, we have good information, but it's not always 100% clear. And as you saw last time with the PPP, guidance continued to change throughout months and months after the programs were established. And so there's still the likelihood of more guidance to unfold over the coming weeks and months that you need to stay on top of, and that we'll be here to help you do that as well. So the first thing that we really want to talk about is this new PPP, which they are now calling the second draw PPP. And why is this important? Because, for some business owners, it was a very good lifeline this past year, and improvements were made throughout the course of the program. And so now there's the second draw PPP, which we want to unpack. So it's basically another $275 billion, a little bit more than that, plus unused PPP funds from the first round that is now available through March 31st, 2020. But there are nuances with who is eligible for this PPP. And it opened up about 3 weeks ago, but there are still plenty of funds available. If you're on the fence about applying or thinking about it, there's still plenty of monies available to go out and apply. So as of Friday, 2021, only 68 billion of loans have been approved out of the $284 billion program. So 70% of the funds remain available. So if you think that you've missed the boat or haven't been clarified whether you qualify or not, there's still plenty of money out there to go off and apply. So Make sure that it fits for you, which we'll dig into in a couple minutes here, whether you can qualify or what you need to be aware of when you do. But there's still plenty of money to go around for another second draw PPP loan. So I think we need to talk about who is eligible for this PPP2, as I call it. And so PPP2 has a few different rules regarding your eligibility that are different from PPP round one. So one, you need to be in business as of February 15th of 2020. So you still, you can have a newer business rather than being established for many, many years, but you have to have a business as of February 15th, 2020. The biggest change with this is that you need to show a reduction in revenue of 25% in any one quarter of 2020 versus 2019. So they put a new threshold. It's not that anybody can apply. You have to look at your profit and loss statements and determine whether or not that there was a quarter in 2020 that declined 25% versus the same quarter in 2019. And that can be any quarter. So that's the bar, the hurdle that's been set for you to be able to apply. Even if you're, even if in Q2 you dropped 25% and then you went back to break even in Q3 and Q4, you still qualify for this second draw PPP. So as far as the size of companies, typically you can't have more than 300 employees. So I know most of Big Time's clients, as well as our clients, would qualify. They've tried to make sure that those who are going to be getting this loan aren't these huge public companies. So that's the other qualification. And you cannot have a PPP loan under review. Now, under review is different than in the review of your forgiveness. It means that they're reviewing your PPP loan because maybe you were ineligible in the first place, or that you got the wrong loan amount, or you got more than you should have. It's not just reviewing your initial forgiveness application. It's like your loan is under review, that it is not ineligible from the original PPP round. And you also, in order to be eligible, if you did receive the original PPP, you have to use it all, or you will use all of those original PPP loan on qualified expenses. So if you have an original PPP and you've only been able to use half of it, and you're likely not going to be able to use all of it, you're not going to be eligible for the second round of PPP2. So those are the things about eligibility. The reduction in revenue is really the biggest thing to be aware of. And one other thing to note is that if your loan amount is greater than 150, if you're going to be applying for a $150,000 or more loan, you actually have to provide proof of the revenue decline. So you're going to have to show them your P&L statements, your tax returns, bank statements that will prove that revenue decline if your tax return is not completed. If your loan amount that you're requesting is less than 150, you don't need to provide that documentation, but I do know that many of the banks are still just asking for it anyways. So those are the things that will help you qualify and determine if you're eligible for PPP round two. So as far as how much can you borrow, things have changed here a little bit as well. The maximum loan size has declined. In the past, it was $10 million. Now it's $2 million for an individual loan. If you are affiliated in a bigger corporate group or a corporate entity with multiple companies, the maximum group affiliation is actually a $4 million loan. So for many employers that are $3, $5, $10 million revenue companies, you are likely going to be able to, this loan amount should be more than sufficient. And so the actual amount that you can borrow is essentially the same as what it was in the prior PPP. It looks at 2.5 times your average monthly payroll, but there's 3 different ways in which you can calculate your loan amount or what you are going to apply for. You can look at your calendar year 2019, which is the exact same as PPP round 1, or you can look at your average monthly payroll for the calendar year of 2020, which might give you a different loan amount because your payroll may have changed over in 2020 versus 2019. Or you can get a loan amount for the 1-year period before the date on which the loan was made. So if you're applying in February of 2021, you can look from January 21, prior, through the 12-month period before that. So that's essentially the monthly payroll of the loan amount that you can apply for. So you can go in and look and see what's most optimal for you when you go to apply for this loan. Now, they did soften the rules, and they're providing 3.5 times average monthly payroll for a certain business industry that you have to have the NAICS Section 72 companies. These are really restaurants, lodging, or food service. So now this go around, those type of industries can actually apply for a greater loan than they previously did. But for those of us, engineering, professional services, what have you, we are in that 2.5 times average monthly payroll amount in terms of the maximum loan amount. And it's important for you to know that. There's some strategic decisions that you'll make regarding that, which we'll touch on in a couple minutes. So once you get the loan, the other thing is, how can you then spend the money? And so this has now changed with PPP round 2 as well. The previously allowed expenses are still there. Payroll, certain health and retirement benefits for your employees, paying rent or mortgage interest, as well as utilities. But they've expanded the list of covered expenses that can help you qualify to ensure that you utilize this entire loan amount that you receive. So these expanded covered expenses include new operating expenses such as business software, CRMs, payroll, HR tracking, things that support that big time software could be a eligible expense. Property damage costs. So due to the riots and looting and vandalism, you can now receive money to help restore or rebuild any of your offices that could have been damaged or commercial space due to the looting and vandalism in 2020, only if it was not covered by insurance or other sources. There's also supplier costs that are a new covered expense these would be essential to the operations that you already have a contract or a purchase order already in place. So those are an additional expense. And now other worker protection expenditures such as personal protective equipment, whether you're building out your office to ensure there's barriers in place, other expansion of facilities, or you have to create a drive-through window to make things safe for your clients and customers to utilize. Those are now covered expenses. And now they've dedicated some additional language to say that group life, group disability, vision, dental are all covered expenses, whereas the last go around, they only made it clear about health insurance, but they've identified those specifically as now covered expenses. So now you have the ability to spend this on more money to ensure that you're going to potentially maximize the loan for yourself and your company. So a couple of things to be aware of. As owner employees, you are still only eligible for $20,833 when it comes to payroll costs. So when you're spending this money on payroll, owners only count for $20,833 is the maximum amount over 24 weeks, while as employees can be more like $45,000 in payroll over a 24-week period of time. So you still have anywhere from 8 weeks at the minimum to 24 weeks to spend the funds. And it can be somewhere in between there as well. So if you deplete your PPP loan and use it on qualified expenses after week 15, you can then apply for forgiveness at that time. You don't need to go the whole 24-week period, but it's a minimum of 8, maximum of 24. So that's the big thing. And the other thing with that is that when you're spending the money and it comes time to forgiveness, the 60-40 ratio that was in effect in PPP round 1 is still in effect in this second draw PPP. It means you have to spend 60% on payroll related uses and 40% to the non-payroll items, whether it's rent, utilities, or all these other covered expenses now. So those things remain the same. So when you're thinking about the PPP, I think there's been a lot of people that have been on the fence. They don't know if they fully qualify. They don't know if they're going to be able to get back to the same levels of employment. They might have let people go. But there's some strategic considerations that you need to be thinking about. And one is you should be analyzing your payroll amongst those 3 periods to determine your loan amount. For example, loans below 150,000 don't need to prove that revenue decline, and they also have simplified forgiveness. So if in your last PPP round you received a $150,000 loan or a $175,000 loan, do you want to apply for a $175,000 loan that might have more administrative complexities around forgiveness and around the application? So perhaps it makes sense to apply for a smaller loan amount looking at one of those 3 periods. So you don't have the same administrative issues going into, the application and forgiveness. Or perhaps, you have a bigger payroll and you want to get, you need more funds. And so perhaps there's the ability to qualify for more if your payroll has expanded. So you want to be analyzing those different loan periods or payroll periods to determine your loan amounts for your application. So, also the new covered expenditures, that they now allow can now be folded into forgiveness. So if you were thinking about maybe I can't qualify or I won't get full forgiveness, there's now the ability for these new expenses, whether it is, business software that could help enhance your ability towards getting forgiveness, where last go around you couldn't. Perhaps your business was shut down or you slowed down, you couldn't operate, so you didn't have the ability to really, spend all of the money on a qualifying. Now these new expenditures can help you. So mapping that out and understanding how all these new possible ways to spend the money can help you qualify. So those are some strategic considerations, to think about when applying for PPP round 2. They're still saying that necessity is still a factor. We still need to certify that these loans are necessary for the ongoing operations of your business. So that's another, big thing to be aware of. And you still have to have the same full-time, equivalent employee and compensation levels need to be maintained in the same manner for PPP round 1. So if you're going to be letting people go, or if you're not going to be able to get to your employee count, or you've reduced salaries 40% or 50%, you need to get back to those same levels as in prior quarters, and just like PPP 1 to get that full forgiveness. So all of those rules remain in place. So it's really important to be thinking about, can this work out for you and your company? Because of these changes, there's still money available if you have not applied. So I would highly encourage you to do the work and analysis to determine whether this makes sense for you this go round. And the other reason why the PPP is now even better than it was is simply due to the fact that the tax law was clarified, and that we'll get into it in a little bit, but not only is the income that you receive from forgiveness, if you received a $150,000 loan, the income, the forgiveness is not taxable, and all of the money that you spend the PPP on is also a tax deduction. So it does have the best of both worlds now when it comes to this loan and this money. So we're going to talk a little bit about some changes as part of the recent stimulus that can now be impacting business owners as well. And this is the employer retention credit. So the changes now open up the door for more people to potentially qualify for this. And I want you to be aware of that, because it could put significant money back into your pocket. So what is the employer retention credit? Well, this was originally acted as part of the CARES Act, and it's a refundable credit, a refundable tax credit against an employer's share of FICA taxes, your payroll taxes, Social Security, and Medicare. So it was originally designed to reward companies who kept employees on the payroll, and the new Consolidated Appropriations Act of 2021 made changes to this employer retention credit, allowing many more companies to qualify. What we found is that most people took advantage of PPP. And at the time when PPP was enacted, it had said that you can't take PPP and qualify for the employer retention credit. So what changes were made, and why are we bringing this up to you now? Because a few things happened. One, the revenue reduction requirement has been lowered. So we'll get into it in a second, but there was a specific threshold that your revenue had to decline a certain amount in order for you to qualify. Well, they lowered that revenue reduction requirement. That could open the door for more business owners to qualify for this credit. Two, businesses that received a PPP are now actually eligible to apply. So even retroactively, even in 2020, that if you received a PPP, you can now go back and look at your payroll to determine if you can apply for the employer retention credit and get both forgiveness and the employer retention credit. However, you cannot claim credit on wages paid with PPP funds. So let me lay this out for you. Let's just say that you received a PPP loan in 2020. Your PPP loan lasted 24 weeks and it ended on October 1st of 2020. Wages paid in November and December would now potentially be eligible for you to get a tax credit for this employer retention credit because your PPP had ended and you still potentially qualify for the employer retention credit on wages after that. So not only can you look back and see this retroactively, but now the program has been extended into 2021 as well, the first 2 quarters of 2021, which you potentially could qualify for. So what is this actual credit? So it's 50% of qualified wages paid to an employee capped at $5,000. So that is the amount of the credit that you can receive per employee for 2020 if you do qualify. So $5,000 per employee if you qualify. Now in 2021, they upped that amount. That says 70% of qualified wages paid to an employee, that's capped at $7,000 per employee for each of the first 2 quarters. So if we break this down and a company actually does qualify, companies could be receiving as much as $19,000 in tax credit per employee for 2020 and 2021. Now, it doesn't mean that you're just going to get the credit because it's out there. There are some rules and guidelines in terms of who actually does qualify, but that's a significant amount of money if you do qualify. And these tax credits, are putting money back into your pocket, back into your business bank account. So it could be pretty powerful now that the rules have shifted. So let's talk about who is actually eligible. So for 2020, it has a little different bar, a little different threshold. Basically, it says that in any quarter, a company saw their gross receipts less than 50% of the gross receipts in the same quarter of 2019. So what does that mean in plain English? You have to have realized a 50% revenue decline in any one quarter. Or your operations were either fully or partially suspended by a government order related to COVID-19. That's how you qualify. And so many companies can have clear documentation that their operations, they did have to shut down due to a government order. And at the same token, other companies might have experienced a revenue decline of 50% in 2020 in any of those final 3 quarters. So if that was the case, you can claim that credit as long as your revenue decline was 20% or more in those successive quarters. So that's for 2020. For 2021, the rules have now changed. They're saying that your gross receipts can be less than 80% of their gross receipts in the same quarter in 2019. So you're still comparing to 2019, but now you only need to show a 20% revenue decline in Q1 of 2021 and Q2 of 2021 to qualify for this employer retention credit. So you don't have that same hurdle in terms of your revenue loss to be able to qualify. And so you're going to be comparing 2021 versus 2019. And at the same token, your operations would have to be fully or partially suspended by a government order related to COVID-19. So some companies might qualify for 2020's credit as well as 2021. There's still a few cards to come out of the deck because we're only in February, but there's things that you can do to get an advance on your potential tax credit. So what wages, how do you qualify for this credit if you do qualify? So it's really looking at wages and compensation in general that are subject to these payroll taxes, as well as qualified health expenses that are employer paid. Those are what are qualified wages. And so, looking at salaries, looking at your payroll are the things that are going to be helping you determine what wages qualify. And so an employer who actually takes, the employee retention credit cannot take credit on those same qualified wages for any paid family medical leave. So there's a few stipulations there. And this is different than PPP. It's looking at your full-time employees to determine who qualifies for the credit. So part-time is different than full-time, and the determination is different than the PPP full-time employee equivalent. So in this case, a full-time employee is defined as one that in any calendar month worked at least 30 hours per week or 130 hours in a month. So whereas the full-time employee equivalent in the PPP was really 40 hours per week, this is 30 hours per week. So there are some differences here in terms of what wages actually qualify. And the wages, the maximum wage amount is $10,000. So the credit for 2020 is 50% of $10,000 in maximum wages. In 2021, it's $10,000 of wages in Q1 and $10,000 of wages in Q2, up to 70%. So if your employee is actually included in this employer retention credit, you can't double dip. You can't, claim the work opportunity or the R&D tax credit for this quarter on those employees as part of the employee retention credit. So how do you actually then go about receiving the credit if you are eligible? So one, the credit is taken off your quarterly payroll tax bill. You can amend your Form 941 with a 941X if you go back and determine that you qualified for the credit in, say, 2020. And so if your tax credit ends up being greater than the amount paid in, you can still receive a check from the IRS. So they'll still give you money back, even if your credit amount is greater than what you actually had to pay in to for payroll tax. And they are also allowing advance payments of the credit up to 70% of your average quarterly wages paid by the employer in calendar year 2019. So you can get money back into your pocket in advance prior to actually experiencing the revenue decline, but then they are going to, when you do file your payroll taxes, this will all be adjusted and worked out. So some of the guidelines here are not completely clear, as I mentioned at the beginning. So we're still waiting on guidance from the IRS, regarding how we completely calculate everything for those that received a PPP loan who now may be eligible for the employee retention credit, as well as specifically the process to apply and amend your prior quarter's returns. Some of those things have not been completely ironed out, but could be really valuable. In our experience, we know of companies that saw a revenue decline of 50% in Q1 or Q2 of 2020, then they were down 30 or 25% in Q3 and Q4. Their PPP ran off, so now they're going to be eligible to apply for this credit retroactively and amend prior quarter payroll tax returns to receive money back into their pocket. So it's something to look at pretty closely if you may qualify. And some CPAs are up to date on it. There's some other tax firms that are more specialized in these tax credit arenas that do a really good job of sorting through your applying for this. So happy to dive more into that in a little bit. So the next thing that I want to talk to you about is some also SBA loan enhancements that are providing more funding and flexibility for SBA loans. So I think what's important here that we're trying to touch on is that some companies have been impacted significantly negatively during this COVID era, while others have grown. And we want to be sharing things that can, from a defensive standpoint, that can improve cash flow for all companies, but also for those that are able to go on offense and might be making investments and thinking about the future. And so there's a few common SBA loan programs that are out there. One is the 7A loan. This is the most common SBA loan program, and it covers a broad range of loan proceeds. Whether you're going to be buying a business, you need funds for working capital, you want to refinance existing debt, you want to buy out a business partner, you want to purchase equipment. So you might have business plans this year to do certain things where these loan programs could actually help you and do so more cost effectively than in the past. There's also the 504 loan, which is a real estate and equipment loan. You need 10% down for this loan, and it's 50% a conventional bank loan and then 40% this SBA loan that has a fixed rate of 20 to 25 years. So we have clients that might be purchasing buildings or buying a commercial office or buying another business. It's worthwhile to look into these loans due to the changes that the stimulus program has made. So the enhancements, let's talk about them. They have now waived borrower and lender fees for 7A loans and 504 loans. So some of those ongoing costs at the start are now being waived. So the next thing is that the SBA is going to cover the first 6 months of your principal and interest on newly approved SBA loans. and it's going to resume for all loans approved between February 1 and September 30th. It's capped at $9,000 per month. But think about this. You're not paying any fees up front, and then you're not having to make payments on 6 months of your principal and interest. So it's pretty powerful. It can be significant amounts of money, which we'll talk about in a second. And it also increases the guarantee up to 90%. So the SBA is actually taking on more risk of this loan. And all of the payments that the SBA makes on your behalf for those first 6 months, they are not taxable income to you. So it's just free money from the SBA. One other thing to note, that if you actually have an SBA loan in place prior to the CARES Act, which came out in 2020, you're going to receive an additional 3 months of principal and interest paid by the SBA, capped at $9,000 per month, whereas some industries are going to get an additional 5 months of payments on their SBA loans that they already have in place if your industry was really hard hit. So let's think about this. What are the savings if you are to apply for an SBA loan now? So, we have a client that, is going to be purchasing a commercial building. If you think about the loan size, you can see the total savings that the SBA is going to be providing. So if I'm going to borrow $500,000, the guarantee has gone up, but now the fees are reduced. So I'm not going to be paying $11,000 in fees. And then they're going to be also making, payments for 6 months on my behalf. So I'm going to be saving $45,000 by taking on an SBA loan. Now you still need to compare the SBA loan to other commercial loans, but this is something to absolutely be aware of now that they've made these, enhancements. Are you going to be acquiring a business? Do you want to buy a new business? Do you have to buy out a business partner? All the things that you might need that you want to help your business grow and for your future can be had with an SBA 7A loan and provide pretty significant savings depending on the size of the loan. Now, the savings with the SBA 504 loan right now, due to the new rulings, same thing. The SBA loan, because some of it's going to be a bank loan, some of it's going to be a 504 loan. Your monthly principal and interest payments, they're going to be, providing savings, as well as the processing fees are all going to be providing savings. And, so you can see on a $500,000 loan, there's $20,000 of savings. $1 million loan, there's $38,000 of savings. So pretty powerful potential loan enhancements that the SBA is offering small businesses. So it's something to consider if you have plans for growth, plans for new purchases, new equipment, you need working capital. We would definitely recommend considering this due to these new loan enhancements that have been created with the stimulus plan. So that talks about some of the recently enacted changes of the stimulus. We wanted to talk about looking ahead, just things to be aware of as Biden has proposed a stimulus program. He's also proposed changes as far as the overall tax code goes. And so let's talk about the potential impact of those things on business owners. So I want to share these things that might be impacting you as a business owner. So one of the things that they've talked about is raising the federal minimum wage up to $15 per hour. Obviously, that could impact the profitability of your company. Now, we've already seen minimum wage increases in different, local areas, not necessarily federally. But what we've experienced with our clients and communicating with them that have had, minimum wage increases in their current locales, whether it's California that have their own different minimum wage requirements, is that not only does the minimum wage go up, but that raise trickles up through the employee base. So we have clients that have owned businesses in that their frontline minimum wage worker got this minimum wage raise, but now the employees that might be the managers of those people seem to expect the raise themselves. So that raise seems to be trickling up throughout the organization, that you can't just consider the minimum wage, though all the other employees want to get their incremental raise as well. Not saying that it's a must or it's mandated, but it becomes part of the conversation as part of your company, and maybe part of the overall budgeting that you need to think about and how that could impact your company. So other things that are out there, they're going to be extending the federal eviction moratorium through September 30th. They're going to be providing $25 billion of rental assistance. So, many clients of ours own rental properties. It might be multifamily. That these rental assistance program ends up helping them in their own financial and investment lives as well. We also see some new small business grants as well as additional low interest rate loans through this future stimulus. It's yet to be defined. It still needs to be passed, and we're going through this period where Congress is kind of battling back and forth to come to some type of negotiation. There's also talk of $1,400 per person stimulus checks to households, and this is one of the areas where Biden said that he's not going to budge on. So it doesn't necessarily impact you specifically, but it might impact your employees. And then they're also going to potentially expand the unemployment program at $400 per week through September. So those are the things in the stimulus proposals that could impact us as businesses and business owners to be aware of. Now, as far as the tax plan goes, this is something that may come to fruition in 2021. It's more likely that these changes will likely be enacted in 2022, but you never know. There could be talk of implementing things retroactively, but we still think that's a low probability event. It's kind of like, if we're driving down the road and the speed limit in 2021 is 65, and they change it to 55 and in 2022 retroactively, then they're going to give you a ticket. So we don't think that it's necessarily going to happen in 2021, but there's the potential for it. And so what's actually going to be happening if this tax plan comes to fruition? Well, there's going to be higher income tax rates for individuals and corporations, and I'll show you that more specifically. The highest individual tax rate is going to revert back to where it was before the TCJA went into effect in 2018. That highest tax bracket is going to go to 39.6%. The corporate tax rate, for C Corps, that is going to go up to 28%. Right now, it was lowered, it's at 21%. So the corporate tax rate would be increased to 28%, which might make, there might be strategic decisions around how you want your business to be taxed as an S Corp or a C Corp. Now, the capital gains tax rate is proposed to increase to 39.6% on income greater than $1 million. So perhaps you're in the, there's the potential for you to sell your business for $3 million in 2022. Well, that tax rate might be double than where it is right now, the capital gains that you'd realize on your service business, because that could all be taxable income. It might be over $1 million, and all of a sudden, instead of being in the 15 or 20% capital gains bracket, you're paying close to 40% federal tax on a capital gain above $1 million. So pretty significant potential change for those that might be exiting our businesses in the future and realizing capital gains on the sale of the business. Other talk in terms of the tax plan, they might eliminate the step up in basis. There would be a cap on itemized deductions for high income earners. So, writing off mortgage interest expense or charitable deductions or our property taxes. It's, you could be in the 39% tax bracket, but they're only going to cap it they're only going to give you a 28%, deduction for those itemized deductions. And there's also talk on changing the 401k deductions, whereas now, if you're in the highest tax bracket of 37%, your 401k pre-tax deduction will save you money at your marginal tax brackets. They're saying that across the board, the deduction would be 26%, no matter what tax bracket you're in. So you're not going to be able to shield money at your highest tax brackets under this new tax plan. And then the other thing that's happening and potentially proposed to happen is that the estate tax exemption would be reduced down to $3.5 million per person, down from $11.58 million per person. So a married couple would basically have $7 million of exemption, and anything above that would be then taxable at 40 or 45% as proposed. Whereas now, a couple could basically gift about $23 million and there would be no estate tax. So that seems like low-hanging fruit for the government to increase their tax revenues on estates, and as well as raising tax brackets. So here's a little bit of a visual of where these tax brackets are going to impact on the individual side for people. This compares the individual and married filing jointly tax brackets, the current versus the proposed. And so you can see what would happen here under Biden's proposed tax plan. So basically the taxable income is at the bottom, 100, 200, 300, 400, 500, 600, $700,000. That Biden's tax plan of the 39.6% would show up at $400,000 of taxable income for a married filing jointly couple. As it stands right now, that 400,000 would be taxed at 35%, and then some of it at 37%. So you can see that tax brackets are going to be going up for those making $400,000 or more. And then as far as an individual, really the same thing is in effect. You're going to now be having your tax bracket at 39.6 versus 35 and 37. So the potential damage done via increase is going to be, more dramatic for individuals who are not already in the highest income tax bracket, because you're going to, lower income is going to help push you into the higher tax bracket now. So, business owners, people that, need to be aware of these changes and how it may impact them. So that's the individual tax plan changes and how it's going to be changing. So now thinking about the tax plan, we just wanted to share with you a few things to be thinking about as it comes to the tax code and what strategies you can put in place. And some high level things, we just touched on one of them before, but now expenses paid with your forgiven PPP funds are now deductible for federal income tax purposes. This is great news for people who receive the PPP loan. It's basically kind of free money for your business as long as you get full forgiveness. However, for certain states, they are actually not conforming to federal. So in California, your PPP loan the money that you spend with your PPP loan is not going to be a deductible expense, as an example. So make sure that you're doing your tax planning and tax projection for 2020 and even 2021 with new PPP funds, so you are clear on how this PPP will be treated and what that will mean for your tax liability. Some other new things is that EIDL advance grant. So many people received this EIDL advance grant up to $10,000 last year. It's not going to be taxable income for you as well, like the PPP. So if you spent that money on payroll or whatever you did, that money is now not taxable. And if you have not yet applied for forgiveness, it's not going to impact your forgiveness. So on the prior PPP loan forgiveness applications, you would say, did I receive an EIDL advance grant? You'd have to put that amount, and then it would reduce your forgiveness amount. Now, if you have not applied quite yet, you can still be given forgiveness on the full PPP loan as well as the EIDL advance grant. So that's another positive change. And so those are things to be aware of. Now there's a deadline to repay deferred payroll taxes has now been extended. So some people deferred their payroll tax, and you now can carry over any unused 2020 flexible spending account balances through 2021 and into 2022. So some of you might have flexible spending accounts through your own companies, or your partners do through their employers that you use for medical expenses. Those can now be used in, it's not use it or lose it in 2020. You can actually roll those over and use them in future years. So a couple things to be aware of out there. Now, we talked about some of those tax law changes. We want to talk about some tax planning opportunities. The first thing I want to bring up is the NOL carryback. This changed as part of the CARES Act, and it's something that business owners need to be aware of, especially if they had a difficult year in 2020. Now, that difficult year in 2020 might be impacted now by this PPP that you received, and so got to understand the math and where you stand. But so what is an NOL? What is a net operating loss? So an NOL is the excess of a business tax deductions for the tax year over its taxable income for that year. So basically, if your business had a loss in 2020, that would be considered a net operating loss. So under the CARES Act, a net operating loss from 2018, 2019, and 2020 can now be carried back and to allow you to get refunds on prior income in the 5 years preceding that, as opposed to having to carry it forward as the most current law had. So if you do have an NOL, if your business did operate a loss in 2020 or 2019, you can now go back and claim a tax refund for those years. But you have to go back to the earliest year in the 5-year period as a starting point. So if your NOL was in 2019, you've got to go first to 2014, then 2015 to use that NOL up. You can't selectively pick and choose the better years. However, this NOL might be better for C Corps because the tax brackets prior to the tax code changing, the TCJA, were 35% versus 21%. So it's something to think about where strategically I can go back and get a refund at these higher brackets. What's involved in doing that? It will require amending your tax returns for all the carryback years as of that December 31st. So definitely an opportunity for those businesses that have suffered and that are going to show a loss. That's one way to get a quick cash infusion in your pocket if those prior years showed income where you had to pay tax on. So that's something to consider. Now, another thing that has since changed over this past year, not as part of the CARES Act, but as part of the Secure Act, which was passed at the end of 2019, but still has applicability to business owners now, is that owners can actually establish a defined benefit plan for their company for 2020. And I say still is because prior to 2020, employers could not adopt a qualified retirement plan after the close of the taxable year. So basically, if you wanted to set up a cash balance plan or a defined benefit plan, that plan had to be adopted and in place and signed off by December 31st. Now you technically have until your tax return extension deadline, corporate-wise, to establish a plan. So for some companies, it might make sense if you might be a solo employer without a lot of employees and had a really good year, a solid year, you can still think about creating a plan for 2020 and getting this big deduction. So if your income rose in 2020, you still have time to do it. So why would this be important? And why would somebody even consider this? Let's just say that a 50-year-old business owner that has, a solo, architect could contribute $162,000 to a cash balance or defined benefit plan above and beyond the 401k salary deferral of $26,000 to really turbocharge their retirement savings. So many people might be maxing out their 401k, putting $26,000 in, or even the profit sharing SEP contribution on top of that to get to $60,000. This can add another $162,000 to your retirement coffers on a pre-tax basis, and you can still do that. So even if you didn't have your plan in place, the third-party administrators will still help you adopt a plan. So that might be something to consider before you actually file your corporate and individual taxes. Is, do I want to set one up for 2020? Possibly. There's a lot of different considerations, your demographics of your company, the payroll, your age, your future cash flow projections all impact this. But for that 50-year-old employee, being able to do that could save $50,000 of potential taxes just by establishing a defined benefit plan for this prior year. So that's also something to consider. And so what's going to be happening in the tax landscape? How do we prepare for these potentially higher tax rates? Maybe you want to be accelerating income into 2021 and deferring expenses into 2022. Kind of the opposite. In the past, people would always defer expenses, or they'd accelerate expenses. But if tax rates are going to be increasing, perhaps we want to push those expenses off into the future and bring income into lower tax years. And then you also might want to think about doing Roth conversions. So this is where you're going to be taking pre-tax IRA accounts, converting them while your income is in lower brackets versus higher brackets in the future, and having that money grow tax-free. Considering harvesting capital gains this year, that's kind of accelerating income. Other companies might be considering the sale of their business. Is this something that you want to move into 2021 versus 2022 because of where tax rates could be and capital gains tax rates could be in future years? So strategically, your exit planning might make sense. And then for some people that have really significant, sizable, taxable estates, do you want to be planning to get your assets outside of your estate due to these reduced gift and estate tax exemptions? And there's things, because the exemption might drop, there's planning strategies that can allow you to still retain control of the assets that you get out of your estate, such as a spousal lifetime access trust, to help you retain control and use those monies in your lifetime, but also utilize your exemption and get these highly valued assets out of your estate before that exemption drops. So those are the things that we need to be thinking about and possibly preparing for due to, the tax plan changes. Now, the last thing that I want you to think about is you should be getting a second opinion on your tax return. And you should be doing that every several years. And why do I say that? One is because you can only amend your tax returns once every 3 years. So if you don't, and the accountant and tax advisor that you're working with potentially made an error or you missed an opportunity, if you don't go back and review it, you can't go back and correct that error after 3 years. So what could this mean? It could mean correcting mistakes, claiming missed deductions or tax credits, identifying new laws applied retroactively that could have impacted you, making an S-corp election in prior years. There could be other things that are out there that say, look, it might make sense to actually go back and look at my past few years' returns. So I would say no matter how much you love your CPA, your tax planner, it makes sense to get a second opinion and continue to review that and see, are there opportunities out there? And you can always decide to stay, but there's always that independent third-party review that might make sense for you. So that's the rundown. Love to go over any questions that you may have. I know we covered a lot and a lot of different topics, and appreciate you being a part of this.
Well, that was great, Matt. Thank you so much. A lot of good information there. And we do have quite a few questions that have been submitted, but if any of these spark a question or you still haven't gotten yours in, please feel free to add those, because like I said, if we don't answer them live today, we will follow up with you via email and make sure you get all your questions answered. So starting here with this question from Deborah, she asked, can you tell us anything about forgiveness for the first round?
Yeah, so the forgiveness is, forgiveness is happening right now. You can be applying for forgiveness. There's a simplified process if your loan was less than 150,000. And now that there's been a lot more clarity, we know the tax implications of the forgiveness has been improved, and now the EIDL advanced grant has been improved. So, at this point, most of the news that would say, most of the information that you would need to make a decision on applying, you can go out, it has been there. All the positive stuff that came out for forgiveness has been there. So yeah, it's ready for you to go off and apply. You contact your bank. It's a lot easier for people that had smaller businesses that had smaller loan amounts. And I would just simply be contacting your lender to see what the process is. There's different forms for different size companies, but we've had clients that have already been been approved in terms of their forgiveness application recently. So it's happened. Certain places it happened quicker, but it's ready to go. I don't know if that answers the question. It was pretty broad, but hopefully that helps.
Perfect. This next question here is from Rohit. He asked, how do they calculate the loan amount for PPP2? Is it still 2.5 times average monthly payroll?
Yeah, so it's 2.5 times average monthly payroll, but you have 3 different payroll periods in which you could utilize to figure out your loan amount. You could go back to 2019, which was the original PPP. Alternatively, you could look at your calendar year of 2020, because different people companies made a different payroll. So you could use 2020's average monthly payroll of 2.5 times, or you could use the preceding 12 months of when you applied. So if you're applying now in February, you could look at the prior 12 months from January through February of prior 2020 to determine your loan amount. So you have 3 choices, and it's 2.5 times unless you're a restaurant, hotel, or food service business, essentially.
Makes sense. Kathleen here asked, are we able to use some of the unnecessary 24 weeks of payroll from the forgiveness application for retro ERTC in 2020?
Will you just repeat that so I can adjust it one more time?
Yeah, no worries. She asked, are we able to use some of the unnecessary 24 weeks of payroll from the forgiveness application for retro ERTC in 2020?
So this is where there's going to be some clarification, but if you're I'm trying to think about it this way. If you used up your PPP after week 16, and that was in September, and your PPP is done, then you could still qualify for the employer retention credit after that PPP was complete. Like once you utilized all your PPP funds, you can then claim the employee retention credit after that, as long as that quarter was still below, still met the thresholds of being in that revenue decline of 20% or more. So yes, but this is where there's still going to be some, clarification as to like, what are we presenting to prove this? Because, you're showing things to the PPP forgiveness regarding your 941. So, but yes, as soon as your PPP ends, you can potentially claim the employer retention credit for periods after that, as long as your revenue in that quarter was down 20% or more.
Got it. Next here is from James. He asked, can we use 100% of the loan for payroll?
Yes.
Perfect. Kathy here asked, if I was in business for all of 2019 but paid no wages, am I eligible for the ERC in 2020 if I paid wages in 2020?
Let's see here. All in business, wages. That's a good question. That's a really good question. Let me circle back with you on that one, because there is still the possibility, because they not only did they change the ERC to say, look, you can compare versus 2019, but you can also compare, Q4 of 2020 versus Q3. So I don't have a definitive answer this second, but I'm happy to circle back with you and get you some clarity. That's a great question.
Perfect. Yeah, these questions are kind of like a pop quiz for you
Yes.
on all of this. Kathleen asked, you sure the income must decline 50% for the 2020 ERTC?
There has to be one quarter in which your income declined 50%, or you were shut down, due to COVID restrictions. Some businesses weren't actually shut down, so you got to have clarity there. But yes, 50% decline is the qualifier. But then for successive quarters, to continue to qualify, your business needs to show a 20% or more decline. So if in Q1 or Q2 your business declined 50%, and then Q3 you were back to, break even, you can still qualify based on wages during that the Q2, but you can only qualify as long as it remains over a 20% decline. But yes, 50% is the threshold for 2020. So if you only drop 45% only, you wouldn't qualify for the employer retention credit.
This question here is from John. He asked, can the ERC be taken on owner's wages, S or C corps?
Yeah, it's on all wages, all full-time equivalent wages.
Perfect. Brianna asked a question. She said, our accountant said the ERC has to be applied for through our payroll service. Our payroll service has no idea what I'm talking about. Can I cut out the middleman, and how?
Yeah, it's a good question. I think some payroll services are going to be adapting to this. You're going to want to work with somebody to make sure that you file the forms correctly, whether you're going to have to be amending prior forms or in advance of, if you're still going to qualify in Q1 2021, for example, then you simply would not pay in the amount that your payroll tax says. So you're still going to need to be math done, and you're going to be making less deposits on your payroll tax deposits due to that credit. So there's going to need to be some coordination between your tax advisor, the payroll company, and for you to know what you need to do in order to not pay in because you're eligible for that credit. So I don't have the exact answer, but you're going to need to work with a number of different people to get things in the right place.
And it looks like we're almost to the top of the hour, so we'll do one more question and then wrap up here. This was also from Rohit. He asked, I received an SBA loan in 2020. Can I get another SBA loan in 2021?
I mean, there's nothing that says that you can't get another SBA loan should you qualify. So yeah, if there's a business purpose and you can get approved and it works for your company, you can still absolutely apply for another SBA loan.
Perfect. Well, thank you, Matt, for going through all of those. And I know there was a few people we didn't have time to get to, but just want to be respectful of all of your time in this. But we will follow up with you via email. And I know I saw a few questions come in about a recording and getting a copy of the slides, which I will send out to all of you tomorrow morning, where you can get a PDF of the slides. They're also in the handouts here within the webinar console if you have a chance to grab it right now. I just want to thank you all for joining us today and spending the time to learn more about this. We really appreciate you being here. And Matt, thank you again for taking your time to review all of this with us.
My pleasure. Thank you for having me. Best of luck to everybody. Stay healthy and have a peaceful and productive year.
Awesome. Thank you, everyone.